The inflation rate in the United States fell sharply to 3% year-over-year in June, according to data released by the Department of Labor on Wednesday, signaling that efforts by the Federal Reserve to rein in soaring prices appear to have been effective. The lower-than-expected report found that between May and June, prices increased by just 0.2%. The annual rate was a full percentage point below the 4% rate measured just a month ago, and far below the 9% rate that consumers were facing as recently as last summer. Stripping volatile food and energy prices out of the equation, so-called core inflation was 4.8% year-over-year, also lower than economists had expected. Fed policymakers would like to see that core rate decline to 2%, meaning that there is still considerable room for improvement. But most analysts saw Wednesday's report as very good news. Mark Hamrick, a senior economic analyst at Bankrate.com, told VOA, "We've been on quite the inflation journey over the past couple of years. But as we look at the Consumer Price Index, not only are these measurements better, but they're better than expected, and that's a good combination." On Wednesday morning, President Joe Biden took credit for the positive inflation news in a statement that attributed falling prices to his economic policies, which he referred to as Bidenomics. "Good jobs and lower costs, that's Bidenomics in action," he said. Today's report brings new and encouraging evidence that inflation is falling, while our economy remains strong. Annual inflation has fallen each of the last 12 months and is now down to 3%. We've made this progress while unemployment remains near record lows and a higher share of working age. Americans are in jobs now than in 20 years, when hit 5% in spring 2021. Many Americans could recall similar inflation in the aftermath of the financial crisis in 2008. However, as rates crept upward, historical comparisons receded further into the past, when rates hit a peak of 9.1% in June 2022, were the highest recorded in the U.S. since 1981. The experience has left its mark on U.S. consumers. Multiple recent surveys have found uncertainty about financial security and doubt about the future. In a recent Bankrate survey, only 28% of American adults said they consider themselves financially secure, while 72% said they are not. The majority of Americans, 63%, blamed inflation for their feelings of financial insecurity. The headline rate of inflation has been moving closer to the Fed's 2% target after peaking at more than 9% last year. However, core inflation, which strips out volatile food and energy costs, has proved more sticky, raising expectations that the U.S. Central Bank will need to lift interest rates further. Core CPI fell more modestly, from 5.3% to 4.8% in the June data. The relative stability of this measure over the last year represents medium-term inflation expectations remaining largely well-anchored. A promising sign for the Fed, said Shannon Seary, an economist at Wells Fargo in New York. Core CPI excluding food and energy climbed 4.8% in June, its lowest rate since October 2021. Rents were the biggest contributor to inflation. Rates currently stand at 5%. But Fed officials had indicated, even before June CPI figures emerged, that the bank was getting close to concluding its run of rate hikes. Global stocks pushed record highs for 2023 on the possibility of interest rate hikes drawing to a close. The latest data outlines a welcome trajectory for shoppers who have seen their purchasing power and monthly budgets eroded by persistently high and pervasive price increases for the last 2 years. On a monthly basis, prices increased by 0.2%, a cooler reading than the 0.4% increase seen in May, according to the report. Gas prices picked up 1% from May, but are down nearly 27% from a year ago. Food prices and grocery store prices are up 5.7% and 4.7%, respectively, for the 12 months ended in June. However, eating out remains costlier. Food away from home inflation is up 7.7% year-over-year, according to the report, squeezed by painfully high prices for 2 years. Americans have gained some much-needed relief, with inflation reaching its lowest point since early 2021 to 3% in June compared with a year earlier, thanks in part to easing prices for gasoline, airline fares, used cars, and groceries. With the better-than-expected inflation data, the Fed is considered all but sure to raise its benchmark rate when it meets in 2 weeks. But with price increases slowing or even falling outright across a range of goods and services, many economists say they think the central bank could hold off on what had been expected to be another rate hike in September should inflation continue to cool. The Fed has raised its benchmark rate by a substantial 5 percentage points since March 2022, the steepest pace of increases in 4 decades. Its expected hike this month will follow the central bank's decision to pause its rate increases last month after 10 consecutive hikes. Thank you for tuning in today's video. We hope you found the information informative. To stay connected with us, make sure to subscribe our channel and hit the notification bell. That way, you won't miss any future updates.